at 30 takes you downtown for the weekly luncheon meeting of the City Club of Portland. Live weekly coverage of City Club is made possible in part by TCI and is produced through the facilities of Portland Cable Access. Now we join the City Club for this week's program.
Good afternoon. Good afternoon.
How do you turn this on? I don't think you're on.
Yeah. Good afternoon. Yep.
Oh, I think she's testing.
Oops. I'm actually going to take notes for the meeting. I can.
What do they do with the television?
What do they do with
I
it?
mean, where's that broadcast?
On cable, on public access.
When? Like Sunday morning at 5?
Very strange hours, yeah.
Good.
No exposure there.
Yeah, okay. Nice.
No,
There's Jane.
this is like my second and my
Oh,
morning.
Good afternoon. Great. I am Susan Deskamp, member of the Board of Governors of City Club. Welcome to City Club and another outstanding Friday program. This time featuring the topic of tax reform with John Mitchell, economist and chair of Phase 1 of the Governor's Task Force on Tax Reform. With him are 3 members of the club's own task force. In a special workshop format, the City Club's Task Force on Tax Reform will discuss its findings so far with Mr. Mitchell and members present here in the audience. Next Friday, December 18th, please join us for our annual holiday program featuring the Oregon Repertory Singers as we salute the holiday season. And please note, that will be at the MAC, again, back to our regular place. I want to remind you all of this year's annual fund. In addition to a monetary goal of $80,000, we have a goal of 100% club participation. The drive is going very well, but with 2 weeks left, we need to encourage you to call in your pledge now. Dues only cover 57% of the City Club's expenses, and so for continuation of our fine programs and study reports, we encourage you to contribute to the City Club. We note that 2 weeks ago, former City Club member and past president Bob McMiniman passed away. We extend sincere condolences to his family and friends. Before I introduce today's program, I acknowledge the other members of the club's Task Force on Tax Reform. That's tricky to say. This group has been meeting diligently on a weekly basis for over a year. The workbook on your tables and in the back of the room indicates their findings so far. Would all of you please stand, all on the committee, and we will give you a round of applause. We will not have a question from a board host today, but we'll proceed directly to questions, first from the club task force members on the dais. After the panel discussion, we will open the program to questions from the City Club members in the audience. But because of the complex nature of today's subject, we will ask that all questions be written. There are forms on your tables, and as a question occurs to you during the program, please write out the question and hold it up in the air. A staff member will pick it up and bring it forward. We will take written questions from City Club members only. Broadcast of City Club programs this quarter is made possible in part because of corporate contributions from Providence Health Systems, Portland General Electric, and Wells Fargo. We are grateful for their support. And now I will turn it over to Don Barney. Thank you.
Thank you, Susan. Welcome to the workshop on tax reform. Today you're part of a work in progress. You're participants in a City Club activity in action. And as your City Club Task Force on Tax Reform pursues its study of the Oregon tax system, we're asking that you here at the Hilton and those who are listening on Oregon Public Broadcasting, not only to listen, but to share your views as we move into the final stretches of our process, which, as Susan has indicated, has already been going on for a year. Your task force, as designed and charged by the Board of Governors, is a different breed of cat from most City Club vehicles. We weren't asked to produce a club report recommending proposals for tax reform. as a research study committee of the club might do. Instead, we've been asked to inform and advise club members about the possible need for reform of Oregon's tax system, and if there's such a need, what the club might do, and by extension perhaps the community, to further the case for tax reform. We've been in business for a year, meeting early, nearly every Tuesday morning. We've had a range of witnesses from former Oregon U.S. Senator and Chair of the U.S. Senate Finance Committee Bob Packwood to Oregon pollsters Tim Hibbets and Bob Moore, who told us that most Oregonians enjoying some level of prosperity don't care very much, right now at least, about tax reform. We've been grappling with terms such as vertical and horizontal equity. We've tried to avoid the S word while glibly discussing consumption taxes, that's sales tax, of course. One of our members swears she's put her newfound knowledge to work as a lively discussion item on her dinner party circuit. Another member of our group comments that he wouldn't want to be invited to any of these dinner parties. Today in this workshop, you'll be working with, first, the initial product from our task force, which is summarized in this week's club bulletin. And there we offer revised criteria for evaluating the tax system and some of our preliminary conclusions on how the current system measures up. Secondly, you'll get the thinking of a top economist, John Mitchell, who chaired the Governor's Tax Review Technical Advisory Committee earlier this year. He'll give you his take on Oregon's tax system, his view of the case for tax reform, and then comment on our work. Third, you'll hear John's responses to questions from the panel members who are up here with me, Tamsin Wassel to my far right, Janice Newton, and David Simon. And as I understand from John, he's at liberty to ask us questions back, and if the dais clears at that point, you'll understand that we've got some grasp of the subject, but we're hanging on here. And then John will also respond to written questions from the floor. We want to ask you to, if you haven't got a copy, there should be extras on your table of a tabletop questionnaire that looks like this. Please fill that out. It will be picked up. We want to look at what your comments are and include those in our deliberations. We would encourage members of the radio audience to forward their views on tax reform to the City Club office to also be included in our deliberations. Let me very briefly describe our preliminary conclusions. As one of our witnesses, Bruce Weber of Oregon State University, describes it, Oregon's tax system has experienced significant change in the past 2 decades. His take on what happens goes like this. Since 1980, the state-local tax system in Oregon has become more progressive, more elastic, more unstable, less predictable, and more vulnerable to recessions. Less than 10 years ago, the property tax was the primary source in the state-local revenue system. By the later 1990s, the income tax was accounting for 41% of the revenue, and the property tax was down at around 30%. The system today appears more attractive to business because of a shift in tax burden toward households and away from business. It is less responsive to local voters, as school funding has become largely a state responsibility and voters face more restrictions on their capacity to increase local government taxes for locally desired investments and services. In this period, we've seen 3 major successful runs at revising the property tax structure through the state initiative system. There's also been significant changes to the federal income tax, which is highly influential on the state income tax structure. And there's been another attempt to institute a sales tax, which was not surprisingly disapproved by Oregon voters. Our evaluation of the tax system began with criteria that were set out in a 1993 City Club research study on tax reform. We've proposed some revision in that set, and that again is included in your City Club bulletin. Among our criteria are clarity. Is the tax system clear and simple enough that it's understandable to Oregon citizens and accessible for their discussion and debate toward improving it? Efficiency. Can taxpayers comply with system requirements with relative ease? Is enforcement consistent and even-handed? Sufficiency. Can we expect the tax system to produce adequate revenue to fund public services that have been established by law? And on a lot of people's mind, that goes, of course, along with the other services to public education. And fairness. This is a tough one to wrestle, and for many, it's the most important one. Fairness in a tax system is, in some cases, maybe many cases, in the eye of the beholder. Fairness is about the taxpayer's ability to pay and also about benefits received by taxpayers. Regarding ability to pay, as taxpayers derive greater economic gain from their work and assets, they contribute a higher percentage of that gain in taxes. That's called vertical equity. Taxpayers who derive similar economic gain from their work and assets pay similar amounts in taxes. That's called horizontal equity. Are your dinner guests really ready for this? Taxpayers who receive special benefits from facilities or services supplied by the government are subject to taxes or fees on those benefits. That's the benefits received principle. Our preliminary thinking after applying our criteria to today's system is summarized again in the bulletin for those who have it handy. Let me say that key points are that on the criteria of fairness, some of our members are coming to the conclusion that Oregon's income tax structure is unfair to lower income taxpayers. We're still debating this one. All of us agree, however, that the property tax in Oregon can be more responsible to those principles of both vertical and horizontal equity, especially with ballot measure 50 now in place. Regarding sufficiency, we note that Oregon's tax system is becoming increasingly reliant on the income tax. That makes state programs funded by the general fund, including the major contribution to public education funding, vulnerable in an economic downturn. We see a need to address this issue, going beyond creating a reserve or rainy day fund, which is an expectation that the current Governor's Committee is expected to bring forward. To get there, we've discussed the question of balance in the system to help improve both fairness and sufficiency. In a balanced system, we see separate taxes on income, property, inheritance, and purchases, each at a relatively low rate, along the lines of Vermont's tax system. We've looked at other systems around the country. We don't offer balance as a basic criteria, but we are leaning toward recommending in our final report pursuit of a balanced system, which of course could reintroduce the S word back into the vocabulary. That's a very quick look at some of our thinking. We will illuminate and detail it in our final report, but we are also likely to change it. And we feel that this session today, hearing from John Mitchell, hearing your questions, getting your feedback on the questionnaire form are an important part of our final conclusions. Enough has been changed, however, we feel in the past 10 years, and not necessarily for the better, to warrant another serious effort to reform the state local tax system. We'll be recommending what the City Club can do to help such an effort when we give you our report early next year. But our goal today is to hear another point of view. It's a pleasure to introduce your task force's witness and the City Club's program guest speaker, John Mitchell. As many of you know, John has been U.S. Bancorp's chief economist for 15 years. He recently completed 14 years as a member of the Governor's Council of Economic Advisors, being chair the past 6 years. Earlier this year, John was chair, as I said before, of the Governor's Tax Review Technical Advisory Committee, which issued its report on Oregon's tax system this past June. This report has informed our work and sparked our recent discussions. John, please be kind, please be gentle, but we're here for your comments. Please join me in welcoming John Mitchell to the City.
Thanks, Don, very much. as I was putting this together, quite honestly, this is not the normal sort of subject that I talk about in my presentations. But I think it's very important for me to lay out right at the start. I am not speaking on behalf of the bank with which I still have some connection, nor am I speaking on behalf of the Technical Review Committee. These are my thoughts. In thinking about this particular gathering, an analogy came to mind, is that this may be rather like the monthly meeting of the Napa Valley Temperance Society. Earnest, well-intentioned, but the size of the following and public support is not clear. I would commend the City Club for studying the issues in the context of an environment that is non-emergency, non-initiative driven, and an environment that has seen major changes in a short period of time in the Oregon tax system. And I think that many of these changes have been invisible to a lot of people. Now, late last year, Governor Kitzhaber appointed the first of two committees, and this has already been covered a bit, to look at the Oregon system. I chaired the first one, this somewhat awkwardly named committee, Governor's Tax Review Technical Advisory Committee. The members were Gary Carlson, Elizabeth Harchenko, Margaret Halleck, Rich Munn, Duncan Wise, and Bruce Weber, who had talked to your committee. Our charge was to look at the changes in the Oregon tax system, to raise questions, not to propose solutions, really to look at the what is, not getting into sort of ought to be value judgment sorts of questions, but look at the changes and evaluate them from the standpoint of stability, fairness, and the achievement of Oregon's social and economic goals. Then our report became the input into the next committee, which is still meeting, chaired by Ron Timpey of Standard Insurance. Now, sort of the whys. This has already been alluded to a bit. We've had major changes in the underlying structure of the Oregon economy in the last 2 decades, in the sense of the relative decline of forest products, the rapid emergence of the technology sector. We've seen nationally major changes in the regulatory environment. You look at what's happened in transportation, telecommunications, those sorts of things. We've had, of course, the initiatives that have changed the system dramatically. And so the governor felt it was time to sort of step back and take a look at what had happened and bifurcate the process, okay, so that we could look at the what is without getting involved in arguments again about what ought to be. And I want to make a few sort of observations. Okay. One, I think, is an extraordinarily important point that I have to keep reminding myself of, and I don't recall during our deliberations who made the point initially, whether it was Jim Scherzinger or Rich Munn, but we have a system that raises revenue to pay for a set of services. We all know that. But there is a tendency to look at taxes, whether we're talking about property taxes, income taxes, whatever, one at a time, divorced from the rest of the structure and divorced from the spending side of the equation. But it is a system that I think one has to look at the whole thing. I noted, and some of you might remember, particularly those from the Oregonian, Earl Blumenauer, Congressman Blumenauer, had a letter to the editor this fall in the newspaper sort of making that point. I think it is an extraordinarily important point. When Don and Nancy and I were together in my office a couple of weeks ago, we were talking about this event, and we were looking at some numbers. It sort of came to me that at one point I think that needs to be made is our committee, your committee, we look at historical data on the Oregon tax system and incidents and comparisons and those sorts of things. We have to remember we're looking at data from a system that doesn't exist anymore. Okay, in the sense that we had Measure 5 put in place, phased in through the early part of the decade. We had Measure 50 put in place. We have a system that has no history, and when we look at data and incidents and that sort of thing and structure, remember the data you're looking at, if they're 95, 96, that's not the system that we have today. And that's not a criticism of the committee or the data. I mean, in fact, it takes time for that stuff to appear. I mean, I don't think necessarily right now there's this great clamor of change for a system that we have not even lived under for a year. One thing about the Republic is that there are 50 laboratories that shows there are different ways of doing things, different ways to raise revenue, to fund services. And I sort of pulled some of that data out and was playing with it. If you throw out the outliers, sort of New York and Alaska, you throw out those kinds of places, then what we're really talking about is a range of tax revenue as a percent of personal income between about 10.4% and 13.3%. Different states have chosen different paths. And I'm not sure is it right or wrong. They're just different. Okay. I want to make points. 3 different definitions, which I think are important to keep in the back of one's mind. Okay. And Don has used slightly different words to make these the points. Okay, we can talk. These are arithmetic terms. Okay, Gus, you can correct me if I get off base here. Okay, we've got regressive tax. Would be a tax that takes a higher percentage of the income at lower levels of income. As income goes up, the percentage taken in tax goes down. That's a regressive tax. Proportional tax is a tax basically that takes the same proportion from different levels of income. And then we have progressive taxes that take higher percentages of income as income goes up, or take a higher percentage as income increases. Now, if you look at Oregon as compared to other places, you can't help but be reminded of the slogan that used to be used by the Economic Development Agency, that things are different here. They are, okay? We all know that. You look at Oregon's system, and it's almost proportional. It's essentially flat, bouncing around that 10% level across the spectrum. And that's old data, and as Bruce said in his testimony, we've moved in a direction of more progressive, sort of less regressive in essence by reducing reliance on the property tax, so those numbers may change as we get newer ones. But most states tend to have a regressive system, basically because of more reliance on consumption-oriented taxes and less reliance on the income taxes. In taxes and services, I think we as individuals are torn. Okay, one quote, Oliver Wendell Holmes, taxes are the price we pay for civilization. But that quotation does not tell us how much civilization to buy or how to fund it. At the other extreme, just another view is sort of the Milton Friedman, Danny DeVito line, there is no end to the good you can do with other people's money. And I think we're sort of torn in looking at the system. When we think about taxes, I think we have to remember there's trade-offs. Economists sort of get involved in this stuff, this stuff a lot, thinking of trade-offs. We've got a number of objectives. Don laid out some of those earlier. We've got fairness, we've got neutrality, we may have balance. And when you start going in for one objective, there are risks to the other objective. I mean, for example, from an equity standpoint, we want to move toward the income tax, but income tax has very different cyclical characteristics than does, for example, in Oregon's case, the property tax that it replaced. Or if we want to encourage certain kinds of behavior, the cost of that can be significant increases in the complexity of the return. In Oregon, we talk about small business entrepreneurship and generating high-wage jobs, and then push the income tax. There are potential conflicts and trade-offs. Now, the committee, the governor's first committee, our report came out in June, and I'm just going to hit some of the highlights, and Don has already done some of that. But it's a document that has, I think, a lot of information and background about some of the changes in the Oregon system. Because in my travels around the state, doing the Rotary clubs and other groups like that, I think there is not a lot of awareness of the magnitude of the transitions that have taken place in the Oregon system. The shift from the property tax to the income tax for school funding is major. As Bruce had indicated in his testimony, we're making the property tax more benefit related in the sense of more of the taxes levied on property are related to the generation of services, police, fire, and the like, less on education, as that has been shifted toward the income tax. And we've made the system more progressive in that sense. But we have also significantly increased the cyclical sensitivity of the Oregon revenue stream to changes in economic activity. Say what one wants to about the property tax, but it is stable compared to the income tax. From a standpoint of local governments, the committee had a lot of concern in the sense, after Measure 50, the limitation of growth, basically an assessed value at 3%, concerns about the flexibility of local governments to meet their demands, the demands for the services, and what happens if inflation accelerates. And I don't think there's a high probability you're going to see a major acceleration, but if you go back to an environment of higher inflation than we've been experiencing in recent years, there could be problems there. And we had a lot of concern about horizontal equity in the sense that under Measure 50 you get values that are locked in, not the reassessments that can correct changes in property values, so that you've got a set of values, and we had some evidence presented to us of houses in the same sort of taxing jurisdictions, same market values, very different assessed values, and there won't necessarily be a mechanism to correct that. Another point that I think is very important and may be important in thinking about why at the moment there may not be a lot of sentiment to change the system is that our system has never, that's just sort of a strong word, been tested by economic weakness. The system, with the property tax limitations, with the increased reliance on income taxes, all during that time period, we've seen a relatively strong expansion. If we had been sort of gathered back in the early 1990s, in the immediate wake of the passage of Measure 5, and of course, remember, there were lots of gloom and doom predictions at that point in time, and we were going to try to think of an environment that would allow Oregon to make it through that transition, that shift in responsibility from property tax to state sources. What might we have thought of? Well, what I really would have liked to have seen would have been a booming economy with rapid increases in personal income, a massive increases in equity values, because we sit here without a capital gains break, okay? And that would bring in state revenue at a very rapid rate. And it happened, okay? So Oregon sort of made it through that transition. But sort of backing away from that a second, we have to understand, we are living in an amazing time period from a business cycle perspective. The U.S. economy started up in 1982, had a 92-month expansion, interrupted by a very short, mild recession in any national sense, and then started up again into a 93-month expansion. Okay? We have never done this before in U.S. history. Okay? If you were born in 1966 or after, you've never seen a serious recession in your adult life, assuming you become an adult at 16. Okay. But I mean, so this has been an unusual time period. And I think we have to remember that. It will not always be this way. And our system has not experienced even a significant slowing, okay, with its current configuration. Now, my reactions to the City Club, and I had access to a draft that Don had sent me. And I'm just going to make like four or five points and then stop. The City Club document, of course, laid out the, sort of benefits criteria, ability to pay, benefits received, horizontal equity, vertical equity notions, and then basically said that they thought that the income tax was unfair. Don said that that's being debated. Now, sort of looking at those numbers or those statements, went back and looked at some of the numbers from the Department of Revenue, which looked at federal gross income as a measure of gross income and tax. Look at the numbers, and this takes out all the dependent returns, like when your kid comes home from college, works for the summer and files. That doesn't really count. Taking those out, so we're looking at full-time residents, that sort of thing. And it's a progressive system. 0 to $10,000, 1.4% rate, 10 to 20, 3.4, 20 to 30, 4.5, 30 to 45, 40 to 60, 50, 5.5%, and 60 to 100,000, 6.1%, and over 100,000, 7.2%. It's a progressive tax. If you look at the distribution of the taxes paid, which is in our publication, the highest 40% pay 85% of the taxes. The lowest 20% of the income tax returns pay less than 1% of the taxes. So it looks like a reasonably progressive system, but the committee presumably has wants that distribution to look differently. From the standpoint of pushing up marginal income, point out trade-offs. I mean, we could raise them, but one of the things we in this room could go up higher in this building to the restaurant at the top. I don't know if it's still there, assuming it's still there. All right, and look to the north and see a place with a zero marginal tax rate on income. Okay. We live along a fault line that's probably one of the most dramatic differentials in systems that exists in the country. And so I think there is the risk there. I mean, same climate, quality of life, that kind of stuff. But you push up the tax rates, and you wonder about some of the location patterns there. I was reminded I couldn't find the early in my career at the bank when taxes actually were an issue at the time. I went to a meeting where someone came down from Washington State Department of Revenue and made the point that if Seattle were located where Vancouver was, the Washington tax system would be changed in a nanosecond. Sort of think about that a second. We'd have a big retail sector, though. Anyway, so and I think there are those kinds of geographic boundaries is a factor that one, I think, has to have in the back of one's mind. And what the committee talked about as sufficiency, on the governor's committee, we talked about stability. Okay, we're basically talking about the same thing. The vulnerability of the current Oregon system to changes in underlying economic activity. And I know as I went through the stuff on the governor's committee, that was one of the things that just jumped out. I mean, as something to be, I think, concerned about, and I would share that that concern that the committee talked about. There was also a point made in the document, and I'm not sure that this is necessarily in the summary that you have, that said that the 2% kicker prevents a rainy day fund. And so I pulled the 2% kicker stuff, and I'm not sure that that's the case. The 2% kicker says that if revenues come in above the close of session forecast, okay, they shall be returned to the taxpayer, unless the legislature decides to keep it. All right, but it's above the close of session forecast. There wouldn't seem to be anything there that would preclude an appropriation to start to build a rainy day fund. Those were some of the things that jumped out. The task force in part of the document toward the end talked about the notion of balance and the possibility of a broad-based system taxing consumption, income, and rates, presumably to avoid the distortions, and doing it in an equitable manner with protection for low-income residents of the state. I was thinking about that, and yesterday I was flying back to Portland, and I was sort of reading through the committee document again, and I had this vague sense of deja vu. And I got into the office actually I remembered it very early this morning, and dug through the files, and my assistant is wonderful about saving things, and I hadn't realized just quite how much tax stuff we had. I would call your attention to something dated April 23rd, 1985, the 1985 Tax Reform and Sales Tax Package. I read through that. What does it do? Or what would it have done? 5% sales tax, home sales, exemptions. 85% of the funds go to property tax relief, 15% to income tax relief, geared primarily to reducing rates at the lower end of the scale. A low-income refund to offset the effects of the sales tax. Okay. And the creation of a rainy day fund was all part of that document, which was rejected about 2-1. Thank you for your attention.
Well, thank you for your research, John, and we'll have to take a good look at that package of 1985. We have a few questions for you, if we may, and I'm going to ask David Simon over here on the other side of the podium to start off.
John, you mentioned that Oregon has shifted from property tax receipts to income tax, and the vulnerability of the general fund, perhaps, of our increasing reliance on income tax with respect to stability. Could you comment on that with respect to the income tax base and the shift from individual income to electronics industries and what that portends for financing of public services out of the general fund?
Am I supposed to stand up? Or?
Yeah.
Oh, okay. I wasn't sure if I was supposed to stand up or sit down. I mean, the notion is that basically income taxes have a higher degree of elasticity or sensitivity to the underlying economy. I mean, if you look at at Oregon tax collections, I don't have 97, 98 data, but if you look at total dollars in property taxes collected between 1990 and 1996, 97, they're essentially the same. I mean, the absolute dollars collected in those 2 years are basically the same. And of course, income has gone up dramatically over that time period. So as a share of income, that has gone down. And we've had this rapid growth in the income tax in this particular environment of very rapid economic growth, very high capital gains. And so if those two things were to go away, or significant slowing in income or disappearance of the capital gains, I mean, that the income tax is going to be, receipts are going to be affected much more, for example, than if the funds were coming from property taxes. I mean, I think that's the bottom line there.
Do you have any guess as to what kind of economic slowdown we're talking about to affect the general fund?
Well, I do have a guess about economic slowdown.
I mean, the purpose of our committee is to arouse interest, and
well, I personally think that the Oregon economy has already started to slow down. And, for example, in 1997, employment growth was 3.4%. When the 1998 numbers are finalized, we'll probably be looking at something on the order of 2.4, 2.5. I suspect it'll drop a bit more next year. The electronics employment has leveled off. We're not seeing that mix of rapid increases in electronics, strength in construction that we've seen. I mean, I think we may be entering that slowdown now. And you've already seen, for example, the forecast that there will be no kicker in the current biennium. And of course, those forecasts change quarter to quarter. But I think we're there in terms of entering that slowdown period, and we're about to test this system with slower economic growth.
Janice?
Good afternoon, John. Oregon, as you know, is one of the few states that does not have a sales tax, and so our committee did look at the possibilities of introducing what we're calling a balanced tax system, and we looked at the possibility of sales or consumption tax. And one of the things we heard the loudest is a sales tax is probably the most regressive element of any state's overall tax system. So if what we are doing is continuing to look at the possibility of a sales tax, what ways can you see taxing, this is my question, what ways can you see taxing consumption in Oregon that can limit or mitigate the natural regressive impacts of such a tax?
Okay, well, actually, you could see that in the 1985 package. I mean, the list of exemptions, food, medicine, home sales, those kinds of things. And there was also an element in that package that had a rebate to low-income individuals to offset the effect of the tax. But again, coming back to the system notion, to the extent that you were using it, at least back then, to reduce property taxes, I mean, that was an element of that change. You were in essence substituting one regressive tax for another one, get somewhat less regressive. Plus, there was a rebate on property tax stuff too.
Okay. Thank you.
Tamsin?
Hi, John.
Hi.
I'm going to ask you a question about a statement you made in terms of that the tax system has many purposes, one of which is about social purposes that we may use it. Some people are suggesting that the use of the tax system may be unfair. There are many social uses for them. I mean, the one that we often hear about is home mortgage deductions. Is a social purpose, or green taxes, environmental taxes. I noticed several of those kinds of questions coming from the audience. So there's lots of social purposes that we use taxes for. Can you comment first in kind of the purity of what do you believe about using a revenue system or a tax system for social purposes? We had heard rumor that ex-Senator Packwood has had second thoughts about the use of the tax system for social purposes. And then at what point does this become unfair to use the tax system for social purposes?
I think the question becomes complexity. When you start using this provision or that provision to encourage certain kinds of activity, you are adding complexity. And if you have a certain, suppose you're trying a certain target revenue that you're getting, and you exempt this or exempt that, then presumably taxes on those other activities that would have to be higher than they otherwise would have been. I mean, it's sort of interesting, you go back to say 1986, when you had a significant sort of simplification of the tax code, and then now, with a couple of intervening changes, it's gotten much more complicated again.
So do you think that we should use the system for social purposes?
I think the notion that we aren't going to try, I think we will continue to try to use the thing. Well, we had a classic example. Look at this tobacco thing. Hey, I mean, that's in essence a tax to try to encourage a certain kind of behavior. Very regressive tax, but we're not. I don't think we're likely to back away from that.
One more question from the panel, Dave.
This was going to be my next question, and it's from the audience. I'm just going to read it. Oregon raises most of its tax revenues from net income and real property. Washington from gross receipts, consumption, and property. What are the major economic consequences of these differences?
Besides rich people moving to Washington? Well, I mean, they're different. It's just fundamentally different approaches. Washington uses a lot of indirect taxes. Taxes, sort of, for example, levied on business. I mean, the company writes the check for the sales tax or the B&O tax, but then those taxes are shifted to parts unknown. And when you levy a tax on business, it's paid by the customers, the workers, or the shareholders. We don't know what that combination is, or some combination thereof. Washington has an extraordinarily regressive tax system. Okay, I think the lowest 20%, the Washington income distribution, I believe their share of the tax is about 17.1% or something like that. Whereas Oregon, it's much lower. It's going to affect, it affects behavior. You can look at a disproportionate amount of retail activity on this side of the line. I mean, we wouldn't probably normally have a shopping center on an island in the middle of a river. That's done for a specific reason. You see people, who are about to have a significant change in their income, change location. I mean, you get those kinds of distortions. But I would admit, both states have really done pretty well. I think we have to be careful not to sort of overemphasize the notion that a tax system is sort of a cure-all or be-all of an economy. You look at the Northwest, Oregon, Washington, and Idaho, extraordinarily different systems. Idaho's the only one that sort of looks remotely like that of the rest of the country, okay? And, all three states have actually fared pretty well.
A couple of questions from the audience. John, why isn't there more interest in using the tax system to go to environmental externalities? In other words, to tax environmental pollution so that we could perhaps again have another aspect to our tax system and bring balance in there and have a new source, in effect, of revenue?
I suspect in part complexity and sort of who's making the decisions as to what those externalities are. I think that might be reasonably difficult to do. And you've got one of the objectives I think here was for clarity of the system. I mean, there is some of it in Oregon, the farm exemption and that sort of thing to preserve land use in agricultural activities. I mean, there is some of that, but we clearly have not made as much use as one might. And we on the Governor's Committee, we looked at the objectives as manifest in Oregon Shines and a little bit as to how the Oregon tax system relates to them. We really haven't made major use of that.
Theoretically, given all other things are equal in a decision of where to live and to do business on either side of the Columbia, which tax system presents a more attractive lure from the residential taxpayer's point of view, and which one from a business owner's point of view?
I think it really depends on the situation. If you are, and I think this came out in some earlier Oregon studies, if you're a startup, you want to be over here, okay? Because you're taxed on your net earnings. Okay, you're not paying B&O and sales and that sort of thing, which are independent of your earnings. But if you're just on the verge of major success, one might think about going across. I mean, it depends on where you are. But the interesting thing is, you look at the overall tax collections in the two states aren't dramatically different. Okay, but just collected in very, very different ways.
I think I know where this one comes from, Ray. Gas taxes are lower than 60 years ago after adjustment for inflation. How about increasing them and using them for the general fund?
Gas taxes? Mm-hmm. Yeah, I mean, one might argue that might be consistent with some people's environmental goals. But I believe in Oregon you've got the system, and correct me if I'm wrong, but I think those are mandated to go for highway and transportation usages. But I mean, you've got the ironic situation in real terms. Of course, energy prices are as low as they've ever been with the collapse in oil prices.
What conditions or factors will need to be in place in your mind to motivate the executive and or the legislature and or the general public to begin to push for tax reform?
We can sit here and, looking at the data, hypothesize about the impacts of a national recession or downturn on this particular system and what it might mean for Oregon. But it is something that people have not experienced. We've had pretty good times, as you indicated, from the standpoint of growth and employment, income. Oregon's been faring pretty well, and we haven't seen the warts of the system. I think it's going to very likely take some experience with that before you'll be able to get people at changing the system.
How vulnerable is the public education system? Your committee's report certainly underscored that, but what's your take on it?
Well, I mean, just the shift from that property tax to the income tax, basically you go back to 1990 and I'm going to be within a couple percentage points, about 2/3 of the K through 12 funding came from the local property tax, 1/3 from the state. Now it is flip-flopped. It's about 2/3 from the state, 1/3 from the local property tax. So if we were to get a significant downturn, a la 1981, or from Oregon's case, 1979 to 1982, when Oregon had one of the most serious declines that any state's experienced since the Great Depression. The only state that fared worse was Michigan. If we had a situation like that, I mean, obviously, I mean, the money goes to education, and a significant cutback that would result in major declines in revenue would hit education very hard. Now, the likelihood of, that kind of a downturn is probably pretty remote now. I mean, we're not dealing with a crushing out double-digit inflation. That's not in the cards. But I mean, definitely in the next time around, public education will be experiencing higher risk.
We've got time for one more. Many voters think all their taxes go to waste and to welfare, so they think they can vote for tax cuts without hurting popular services like education and health care. In fact, most of the state budget goes to education and health care. Would you agree that one critical reform we need is a massive campaign to explain to people that taxes fund popular services?
Well, I mean, I think there is a major lack of awareness of how the system works at the present time, and education would be a part of fixing that. I know you talk. Bruce Weber, does that from his center. I mean, trying to get people to understand these systems. But things have been good. There hadn't been a lot of reason to look at the thing, or to get upset about something. You look at it, I mean, what's happening? Gee, property taxes are going down as a percentage of income, and you're seeing them capped. Barring the, unless you vote to go, are rising rapidly. The income tax system hasn't really changed, okay? So I don't think there's just a lot of incentive right now for people to learn about it. But there will be.
Thank you.
Thank you very much for your attention.
Thank you very much to John Mitchell. He always is so interesting, and it is such a fascinating subject. I hope we all stay tuned. I want to particularly thank Don Barney for chairing this committee and the whole committee. You're wonderful. Your work is not done. Please stay as devoted as you have been, because this is a challenging, important issue, and the City Club is leading the charge. Thank you. We are adjourned.
But he also made the point that